Right, it's William Jiaming from LearnFinanceFree.com, and let's talk a little bit about share repurchase. Okay, so share repurchase. So basically, share repurchase is that, so for example, you're the shareholder of a specific company, and that company want to repurchase the share that you own. Okay, so most of the time it will have like potentially favorable tax treatment, because if the company say, hey, I want give you some dividends, you are the shareholder, you receive dividends from the company, right? And then you have to there's a dividend tax in most of the countries in this world. So that sort of tax normally is pretty high, because it's kind of a way of just take money out from the company and distribute it to the shareholder. So normally that's the tax is pretty high, because you will no longer take part in these activities. But normally the capital gain tax is a little bit lower, but that really depends. So this potentially that's the reason I add that. But let's talk about another thing. So if you look at the company's balance sheet, we got asset and we got liabilities and we got equity. So if you own the share, basically you own a part of the equity, okay? But if there's a repurchase going on, so basically you will get cash for your share, but that cash come from somewhere, okay? That cash come from here, inside of the balance sheet asset, okay? So basically, the asset will be like reduce the asset, because the company use cash to buy the equity. And remember, here's the tricky part. So if the company already bought the equity that you own, the share that you own, that will be that kind of share is gone, okay? You will no longer be registered. So basically, the share that you sell, because it's like a repurchase, okay? So the share that you sell to the company is gone. So the equity will be reduced, the asset will be reduced as well. So if you think about this, the share repurchase is kind of using the free cash flow, free cash, or maybe whatever the source, just to reduce the whole scale of the company, like reduce it, but also like buy out some of the shareholders. Okay, the shareholders got pretty low and asset got pretty low, but the share repurchase does not change the relationship of the debt holder. So the liability is still this much. So if you think about this, this is kind of like a tricky move, because you essentially pay cash, like if you from a shareholder's point of view, you get cash, okay? You don't worry about whether it's a cash from repurchase or dividends. So you get cash, but you sell part of the share, okay? Because it's repurchase, basically you are selling that share to the company, and that share is gone. But from the company's point of view, the equity got less, the asset got less, the whole scale of the company got less, but the debt's still there. So basically, so if you're talking about, say, financial leverage, financial leverage normally is debt divided by equity, or debt divided by, say, asset, okay? So the asset go down, the equity go down, you don't know what's going on, right? So because it's concerned with a specific ratio, but normally, so for example, the previous is like 4, 2, okay? So all go down by 1, and we got this 3, 1 here. So this will give you 0.5. This will give you 0.3. So basically, it's going down. Okay, but I think this part is a little bit clear because the equity is reducing, but the debt is not reducing, so the leverage go up. Okay, so yeah, that's kind of like a tricky question. Yeah, sorry, the debt is not changed. So sorry, ignore all this part. The debt is not changing. Okay, while the asset going down, so the whole leverage go up. Yeah, silly of me. So the financial leverage will go up. Okay, but the asset, the whole scale go down. The shareholders' equity go down, but the liability part still remains the same. So it will increase the whole company's, firm's perspective, increase the whole company's financial leverage, yeah. And of course, you may ask why the company choose to do this. Remember, if the company choose dividends, it kind of send a signal, and dividends have a kind of inertia. So you can't, pay dividends 1 year and don't pay dividends another year, and pay in 1 year another year don't pay. This kind of unstable can signal to the investor that your company is not stable. Okay, so if you paid the last time, you didn't pay this time, maybe something wrong going on with your company. Okay, so they may sell stock, and then the whole company just the stock price go down. So in order to have a more flexible way of doing things, will be the share repurchase. Okay, repurchase. Because share repurchase is pretty rare, okay? So if you we do this time, doesn't mean that we have to do it next time, okay? Thanks, bye.